earnings are going to be challenged this year for sure. I'm not seeing an economy-wide recession, which then leads to a big drop in earnings. But I do see what I call a rolling recession, in which earnings kind of go sideways through the end of the year before they recover next year.
On Wealth Track, veteran macro strategist Ed Yardeni helps us understand and navigate the cross currents in the markets.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Remember the days of narrow market leadership when the so-called FANG stocks dominated market performance for a decade? Well, in case you need a refresher, the FANGs were Facebook, as Meta was then called, Amazon, Apple, Netflix, and Google, now Alphabet. Well, after a dismal performance in 2022, big tech stocks are back. According to research firm Strategas, 10 stocks have accounted for 90% of the rally in the S&P 500 year to date, and they are the usual suspects, plus some. In order of the largest gains in market cap, they are Apple, Microsoft, Nvidia, Meta, Tesla, Amazon, Alphabet, the parent company of Google, Salesforce, AMD, and Broadcom. The remaining 490 stocks account for just 10% of the S&P's market cap increase. Now, investors are facing some interesting choices. Remember the days of TINA, meaning there is no alternative, in this case to stocks? Well, now there are some. Cash is back. After providing little or no income for years, money market funds are now offering yields as high as 5%, and investors have taken notice. Assets in money market funds recently hit a record $5.2 trillion. Then there is gold. It has soared in the last 6 months and recently traded near record territory at over $2,000 an ounce. All of this against a backdrop of the highest interest rates in years, a Federal Reserve under pressure to pause its fight against inflation, and outbreaks of stress in the banking system. What shape are the economy and markets in, and what is the best course for investors? Those are the questions we are going to put to this week's guest. He is Ed Yardeni, President and Chief Investment Strategist of his macro research and strategy firm Yardeni Research, which he launched in 2007. Yardeni is a PhD economist, longtime Fed watcher, and investment strategist who is widely followed by institutional investors. The firm's output is prodigious. It includes a detailed daily morning briefing and comprehensive What I'm Reading list, his compilation of the most pertinent articles from various news sources. He recently introduced Quick Takes for individual investors, a daily summary of his macroeconomic observations. He is also the author of several books. The latest, In Praise of Profits, is dedicated to progressive to help them understand that profits isn't a four-letter word. Yardeni describes himself as being usually bullish and usually right, although his bullishness proved unusually wrong the last time he was on Wealth Track in early 2022. I asked him what he got wrong.
Well, I view stocks as long-term investments. I think one of the important pieces of the puzzle when you invest in stocks is dividends. And in order to earn the dividends, you have to hold on to the stocks. And it probably makes sense to hold onto the stocks through thick and thin. The problem with trying to call market tops is you also have an obligation as a strategist or as an individual investor to then figure out the bottom. Very many people miss the bottom, and then they wind up getting back to where they were before when they panicked out of the market. In my case, I think that like the Fed, I misjudged inflation. Inflation turned out to be more persistent, though I think it's all a matter of perspective. We certainly have seen inflation in the goods sector come down a great deal, and services has been boosted by rents, and we know that that's a laggard on the inflation scene. So, I guess I wish I'd called the top back in the beginning of January, but I think I called the bottom on October 24th. A few days later, I said that might very well have been the bottom because there was just so much panic.
Right, so far so good. Your stance now is, how would you describe yourself? Bullish?
I think we're in a bull market. Again,
you do?
And to the extent that I have said that, and I repeated quite often, that I thought that the October 12th low was the low. I also thought that the October 24th high in the bond yield at 4.25% was the high, so that's worked out reasonably well. But I don't think it's going to be a V-shaped bull market where everybody is quite aware that this is not exactly a cheap market. It's not as expensive if you take out the big 8, with the so-called mega cap 8 technology names,
Right.
but they're pretty highly valued. They did come down quite a bit, but they just went right back up. And earnings are going to be challenged this year for sure. I'm not seeing an economy-wide recession, which then leads to a big drop in earnings. But I do see what I call a rolling recession, in which earnings kind of go sideways through the end of the year before they recover next year.
A rolling recession, what does that mean, and where are you seeing that?
And what happens in a rolling recession is different industries at different times take turns going down. And in the current situation, we have been in a recession since the beginning of last year for single-family housing. And then late last year, retailers had a recession. They had to discount merchandise in order to move it. Meanwhile, services economy has held up pretty well. Capital spending has held up pretty well. And of course, we still have a tremendous amount of fiscal stimulus still to come as a result of the Biden administration's infrastructure spending and so on. I guess we're going to roll next into commercial real estate. And that
Right,
happened,
as far as a recession, that is definitely having its problems. Yep.
Correct. And that happened in the early 1990s as well. And the recession only lasted, I think it was all of 8 months back then. But I don't even expect to see that we'll have an official recession. It'll be more in the nature of a soft landing growth recession.
So this is what I don't understand, given what the Fed's policy has been, which is, one of the most aggressive and fastest rate hike cycles in history. And somebody famously said that that the Fed murders recoveries, and I don't understand why the economy isn't being murdered by this Fed rate hike cycle. What's changed? What's going on?
Oh, it ain't over until it's over. So I could be wrong,
Right.
and it could be on the edge of something like this. We do have a banking crisis now that's kind of reminiscent of previous banking crisis, led to credit crunches and recessions. But the Fed, has a lot of experience with creating emergency facilities to bail out the economy. And it came really very quickly with an emergency facility for the banks. The FDIC came in very quickly to shore up some of the recent weakness in that area. Look, I think part of it is demographics. There's a lot of people my age. I'm still working for a living, but a lot of my friends have retired, and I don't know what I would do with myself if I retired, because I don't play golf, and I enjoy what I'm doing. But what I see a lot of my friends doing is retiring. They've had enough. Maybe because of the pandemic, they had a few months to think about the meaning of life and decided, they've worked all their life. It's time to travel. It's time to spend more time going out to entertainment and restaurants. I mean, restaurant sales are an all-time record high, and demand for healthcare services is an all-time record high. And guess what employment demand is doing in these two very important sectors? It's absolutely booming. And so, usually you need to have a very weak labor market in order to get a recession. Now, I will admit that if you look at the history of the unemployment rate, it does tend to bottom right before recessions, wouldn't you know it? Because the economy is doing so well that inflation picks up and the Fed starts to tap, then slam on the brakes, and then you get a recession. I think in this case, the Federal Reserve will probably stop raising interest rates effective as a result of the banking crisis that started in early March. They've been saying they want to get the federal funds rate up to a restrictive level, and they were kind of arguing whether it was 5.25% or 5.6%. There's some talk in the markets about 6%. We've had a minor little bank run, but we're not out of the woods in that regards. And I think the Fed doesn't want to tip this thing over more than it has already.
How can the Fed pause when the Fed has stated publicly many, many times its commitment to get the inflation rate down to 2%, and we are still a long way from that goal?
Well, I think the Fed has actually been very clear that their aim isn't to just keep raising interest rates forever until the economy falls into recession. They've been saying they want to get the federal funds rate up to a level that they think is restrictive enough to continue to bring inflation down, and then they want to leave it at that level for some time in order to get inflation down. They're talking about getting to their 2.5% inflation target by 2025. So that leaves some time here. They don't have to rush it. And meanwhile, because of the beginning of a credit crisis, which I think they are averting, I think they have to conclude that they've achieved what they wanted to achieve. They're at restrictive. I mean, they can leave the Fed funds rate at 5% for the rest of the year, and that probably will not cause an economy-wide recession, and it'll probably continue to put enough pressure on the inflationary side to bring it down.
Right. But keeping the Fed funds rate at 5%, that's still very tight, considering where we've come from. So that's going to have some repercussions as well, right? For businesses and individuals.
As you know, the markets are actually been predicting, and especially when the Silicon Valley Bank was closed, the markets have been predicting that the Fed is going to be lowering interest rates, and the Fed has tried mightily to convince people that they don't have any intention of lowering rates. And the market says, look at history. History shows that when yield curves invert, something breaks in the financial system. You get a credit crunch, and then you get a recession. And along the way, interest rates peak and come down. That's one of the reasons I thought that the bond yield peaked back on October 24th at 4.25%, is because of the yield curve inversion. It was saying that bond investors came to conclude that if short-term rates were going to keep going up, they weren't going to chase them. They were just going to buy bonds, figuring that we were already in restrictive territory. I think that'll be the real issue here is, will the Fed have the perception that I have that they've done enough, and I think they have to come to that conclusion. And if that's the case, then that will allow them to leave it at 5% for a while. If they keep going, then we will have the typical peak in the Fed funds rate and then a big drop in the Fed funds rate. But that, I think, would require a recession. I mean, just to put things into perspective, it's not like I'm denying the possibility of a recession here. It's rather, I'm putting subjective probabilities of 60% of something like a soft landing and 40% of something like a hard landing.
And what could make the difference? I'm just wondering where we've just, as you said, had a kind of a banking crisis. Jamie Dimon, the CEO and chairman of JP Morgan Chase, says that there are going to be more repercussions from that to come. Is that where we have a possibility of tipping the economy into recession? And what do you see that's going on in the financial system that concerns you?
Well, it is a credit crunch, because, as I said, the history of the business cycle is that we come out of a recession, everything is okay. People are still kind of a little bit traumatized by the recession. Everybody behaves, and then a couple of years later, we forget the recession, and it's boom times, and inflation picks up, and unemployment is extremely low. And then the Fed goes from tapping to slamming on the brakes, and that causes something in the financial system to break, causes a credit crunch, causes a recession. What I need to see is more evidence that what's happening in the banking system is going to turn into an economy-wide credit crunch. So I'll be watching the weekly data that the Fed posts Friday at 4 p.m. And what they do is they show you assets and liabilities of the commercial banking system. And if I see that deposits continue to pour out of banks, especially regional banks, so that's one issue. The other question is the weekly loan numbers. So that'll be very important to watch. There's actually data weekly on commercial real estate loans. And then there's the borrowing data. How much are they actually borrowing to offset the stresses that they're experiencing? Every day that something hasn't blown up in the banking system has been a good day. The stock market's actually done pretty well with this banking crisis. The bears are saying it's going to all fall apart any day, and they'll be watching the credit numbers, and I'm sure if the credit numbers are ambiguous, we'll have a debate on it. If not, we'll have a debate on it anyways.
From an investment point of view, things don't seem to be clear cut by any stretch of the
Right.
imagination. You just mentioned how well tech stocks are doing, the narrow market leadership that I'm saying that we're seeing. I think 90% of the S&P 500's performance year to date has been in 10 stocks, and the fact that gold is hitting new highs. The cash is now such an attractive alternative to stocks. What's your advice to investors?
I think ever since the pandemic, everything's been rather turbulent. A lot about the market, I think, pretty clearly bottomed on October 12th.
Right.
The jury's out. We'll see how that plays out. Yeah, on the stock side, you really have to focus on being a long-term investor. You have to ride these things out. The reason for that is, as I said before, not only do you have to call the top, but you also have to call the bottom. And by the time you get to a bottom, the pessimism that you see at bottoms is just intense. You really, so you wind up missing getting out of the market on a timely basis and not getting in on a timely basis, and it's just been a big spinning of wheels.
The last time you were on a year ago, you mentioned the S&P, 1,500, basically, which is large, small, and mid-cap stock. Just buy the whole market and just forget about it, or what?
I basically agree with Warren Buffett and Professor Jeremy Siegel that we really have to have a more long-term investment strategy towards stocks as opposed to this trading mentality, which Wall Street basically promotes, and
absolutely.
It's really not a good way to invest for the long run. Again, it's the compounding of dividends that really makes a big difference in stocks over time. I think in the bond market, like everybody else, it would have been great if we all bought at 4.25% on the treasuries. The volatility has been just crazy in the bond market. Yeah, you just don't expect to have that kind of volatility in the marketplace. But I have no problems owning 10-year treasuries at 3.5%. It was only a few days ago that I said I'd have no problems owning them at 3.5 to 3.25%. But I do think inflation is going to be coming down rather sharply in coming quarters. And if that's the case, then the bond market, I think, still offers some good opportunities. In a credit crunch situation, you probably, for now, want to avoid getting too excited about the yields available in high-yield instruments or mortgage securities, because you might get a better yield if kind of panic sets in. But as for gold, gold, it's always kind of the default asset to invest in when you think things are going to really come unglued.
Right. Insurance policy against disaster, as Peter Bernstein told me many years ago.
Now suddenly you've got competition for gold has competition with Bitcoin.
I know. Tell me about that, Ed. Bitcoin's been rallying like crazy too.
You're asking me about two assets that don't have dividends, they don't have any yield, they don't have any return, and I'm sort of an old-fashioned strategist. I need something that I can put a valuation multiple on. I really can't.
Gold you can. Gold is very tangible.
But if we're talking about gold bars, there's no return.
Right.
There's
no return.
No return. And same thing with Bitcoin, and they are volatile. The prices of them tend to be quite volatile. And a lot of people have owned gold and been waiting for a long time. So why isn't gold doing a lot better? The world's definitely coming unglued. How long has the world been coming unglued as you and I have been doing this? There's always something to fret about. And sometimes gold works, sometimes it doesn't. I don't really have any trading tools. I don't have any valuation tools to tell you when to get in and out of gold. So most people, as investment strategists or financial advisors, say, "Oh, you always want to have 5-10% of your portfolio in gold," and then they leave it at that, and they never ask why, or why wouldn't I want to have a lot more? How do you know that? The conversation kind of ends because it's just hard to value these things.
At the beginning of the 2020s, you said that you could see a possible analogy between the 1920s and the 2020s.
Correct.
Talking about technological innovation and productivity and prosperity. The beginning of the 2020s didn't start that way.
No.
How do you feel about it now?
Well, neither did the beginning of the 1920s. In the beginning of the 1920s, if you were just an individual or your family, imagine sitting around a Thanksgiving table in 1920. I mean, what was there to give thanks for? Well, at least World War I was over.
The pandemic had ended.
Yeah, but millions of people died, and then in 1920 there was what they still called a depression in the United States. It was, I can't imagine that there were too many people that said, yeah, this too shall pass, and we're going to have a roaring 2020s. It didn't end well, and maybe that's something that I need to respond to, but it didn't end well because of the Smoot-Hawley tariff and a policy mistake. But it's my view that technology solves a lot of problems, and it creates, it stimulates productivity, it increases the standard of living, and I think the technology that we have available to us today lends itself to increasing productivity and substituting for scarce labor in just about every industry, whereas in the past that was not necessarily the case. I mean, even during the 1990s when we had the high-tech revolution, if you had a company that could do something with an Excel spreadsheet or a Word program, then it contributed to productivity. Get rid of all this electric typewriters, and then you can type away on a PC. But it didn't really lend itself to lots of businesses across the board the way automation, robotics, artificial intelligence, I think has the potential to increase productivity. And technology solves problems, and the biggest problem we have in the economy, one of the biggest ones, I don't want to tell you there aren't other problems, but one of the biggest problems is labor shortages.
Absolutely. And so that's something that you think that artificial intelligence and also robotics can at least solve partially and can make a big difference.
Yeah, I mean, it just kind of came out of nowhere, and all of a sudden it was like, whoa, that's an amazing technology.
Powerful.
I mean, just playing with it, I said, well, maybe I can translate my daily commentary into Chinese and Japanese, and I did it. And I don't know if it makes sense, so I ran one in Spanish, and I have a colleague who's fluent in Spanish. She said, this is it's perfect. It's perfect.
Wow, this is ChatGPT that you're using, right?
Yeah. And so, I think we haven't even started to think about what this could do, but you can see the companies are jumping all over it. I mean, this doesn't mean that there'll be no jobs. Somebody's got to read over this stuff to make sure that, HAL 9000 didn't go, berserk and give you something that was totally wrong. But the potential is great. I mean, I've heard that hospitals now are looking at using artificial intelligence to help doctors assess the probability of going in one way or another way when they're doing their operations. I mean, that's remarkable stuff.
Remarkable is right. One investment for a long-term diversified portfolio. Well, what would you recommend we all own some of?
I'm still harping on the S&P 1500. I've got no problems with the mega cap stocks. They got their comeuppance, and they're all managed by people who like to see their stock price up, and they realize that they had to cut some costs in order to show profitability to their investors, and they did it. These are very profitable companies, and it's very easy for them to show those profits by just cutting costs for a quarter or two, and then suddenly it's like, whoa, can't believe all that profit potential that this company has. So I think some of them just got a little sloppy and spent too much on too many kind of projects, and now they're being much more focused, and I think they're going to continue to be world-class competitors.
Ed Yardeni, thanks so much for joining us on Wealth Track.
Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is take advantage of money market rates. Money market mutual funds are one option. There are many run by top investment firms, including Fidelity, Vanguard, DWS, Invesco, and BlackRock. They are currently offering yields of anywhere from 4 to 5%. Their websites are good places to start. Then there are money market accounts at banks. Their rates are generally lower, but they are covered by FDIC insurance up to the usual $250,000 limit and frequently offer check writing privileges. A good website to compare banks' rates and get recommendations is at a website called Bankrate, what used to be called Bankrate Monitor. For those of us old enough to remember, Bankrate Monitor was the go-to source for bank rates during the high interest rate days of yore. Once again, it actually pays to compare rates. Get them while they last. Next week, former Global Mutual Fund star Bill Wilby, now a private investor, discusses the problem with treasuries and why financials are uninvestable. In this week's extra feature, Ed Yardeni tells us why he is offering a research product to individuals. Please follow us on Facebook, Twitter, and our YouTube channel. And especially thank you for spending time with us here today. Have a great weekend and make the week ahead a healthy, profitable, and productive one.